Welcome to Mastering Income Statements, where we'll break down how to read, understand, and analyze one of the most essential financial documents in business. An income statement, also known as a profit and loss statement, summarizes a company's revenues, costs, and expenses during a specific period. Let's begin by understanding the structure of an income statement. The main parts include revenues, cost of goods sold (COGS), gross profit, operating expenses, operating income, other expenses, and net income. Here's a simplified example to get us started. Starting with revenues, often called the top line, this section shows the sales made by the company during the period. For instance, if a company sells 10,000 units at $10 each, its total revenues are $100,000. Cost of goods sold, abbreviated as COGS, refers to the direct costs attributable to the production of the goods sold by a company. Let's say the company has a fixed manufacturing cost of $30,000 and variable costs of $2 per unit. The COGS would be $50,000. Gross profit is obtained by subtracting COGS from revenues. In our case, the gross profit is $50,000. This figure helps us know how effectively the company produces its products. Operating expenses are the costs required to run the business. These include things like salaries, rent, utilities, and marketing expenses. Assume these costs account for $20,000. We subtract this from the gross profit to get the operating income. After deducting operating expenses from the gross profit, the result is the operating income. In our example, it's $30,000. This shows the company's profitability from its core business operations. Next, we consider other expenses and income, such as interest, taxes, and other non-operating expenses. Let's assume these total $5,000. This amount is subtracted from the operating income to find the net income, which represents the company's total profit. Finally, net income, also known as the bottom line, is calculated by subtracting these other expenses from the operating income. In this example, the net income would be $25,000. Analyzing an income statement helps stakeholders understand the profitability, cost management, and overall performance of a company. For instance, high operating expenses might indicate inefficiencies, while rising revenues could indicate business growth. Let's also touch on some common financial ratios derived from the income statement: gross profit margin, operating margin, and net profit margin. These ratios are valuable tools for comparing performance over time or against competitors. Gross profit margin is calculated as gross profit/revenues *100. For our example, the gross profit margin would be $50,000/$100,000. *100 equals 50%. Operating margin is calculated as operating income/revenues *100. In our example, it would be $30,000/$100,000. *100 equals 30%. This reflects the company's efficiency in managing its core business operations. Net profit margin is calculated as net income/revenues *100. For our example, that would be $25,000/$100,000. *100 equals 25%. This margin represents the overall profitability after all expenses. Income statements can vary significantly between industries. For instance, the COGS for a manufacturing company would look quite different from that of a software company due to the nature of what each produces. To give you more clarity on this topic, let's answer some common questions. Question 1. Why is the income statement referred to as a flow statement? Answer: unlike the balance sheet, which is a snapshot of a specific point in time, an income statement shows the flow of revenues and expenses over a period of time. Question 2. How often should businesses review their income statements? Answer: regular reviews, typically monthly or quarterly, help businesses stay on top of their financial health and make timely decisions. In conclusion, understanding an income statement is vital for managing a business's financial performance. By analyzing revenues, costs, and net income, Businesses can make data-driven decisions to enhance profitability and growth.